Hi, this is Dr.S.Valluvan, Assistant Professor, MBA, Dr. SNSInstitutions, College of Arts and Science. This teaching video is about insurance from the subject banking and insurance, studying by second year MBA in the fourth semester. Let's start the topic. The topic is Introduction to Insurance. Let me explain about the meaning of insurance and its principles. Insurance is a contract under which one party, that is insurer or insurance company, agrees in return of a consideration to pay an agreed sum of money to another party to make good for a loss, a damage or injury to something of value in which the insured has financial interest as a result of some uncertain event. In other terms, insurance can be called as a contract of indemnity. We'll see in detail as we go along. Now we'll see the principles of insurance. So these are the principles of insurance. The first one is utmost good faith. Insurance contracts are based upon a mutual trust and confidence between the insurer and the insured. It's a condition of every insurance contract that both the parties, that is insurers and insured, must disclose every material fact and information related to the insurance contract to each other, whether it is a policyholder or an insurance company. They have to disclose the real fact and the material fact when they enter into a contract. That is what we call utmost good faith. And second principles of insurance is insurable interest. It means some pecuniary interest in the subject matter of insurance contract. The insured must have an insurable interest in the subject matter of insurance. That is, life or property insured, the insured will have to incur loss due to this damage, and insured will be benefited if full security is being provided. A businessman has insurable interest in his house, stock, his own life, and that of his wife, children, etc. This is what we call insurable interest. And third principle is indemnity. Indemnity applies to all contracts except the contract of life insurance, because estimation regarding loss of life cannot be made. We cannot estimate the loss of life exactly. The objectives of contract of insurance is to compensate to the insured for the actual loss that he has incurred. This contract provides security from loss and no profit can be made out of this contract. Then indemnity. Principles of indemnity applies to all the contracts except the contract of life insurance. This we saw. And the fourth one is proximate costs. The insurance company will compensate for the loss incurred by the insured due to a reason mentioned in the insurance policy. But if losses are incurred due to reasons which are not mentioned in insurance policy, then principle of proximity costs or the nearest cause is followed. You will see the example in the case study as we go along. Then fifth one is subrogation. This principle applies to all insurance contracts which are contract of indemnity. As per this principle, when any insurance company compensates the insured for loss of any of his property, then all rights related to the property automatically gets transferred to insurance company. So far we have seen the principles of insurance. The first one is utmost good faith, and insurable interest, indemnity, proximate costs, subrogations, and next one is contribution. So according to contribution, the principle, if a person has taken more than one insurance policy for the same risk, then all the insurers will contribute the amount of loss in proportion to the amount assured by each of them and compensate for the actual amount of loss, because of he has no right to recover more than the full amount of his actual loss. Then mitigation. According to this principle, the insured must take reasonable steps to minimize the loss or damage to the insured property. Otherwise, the claim from the insurance company may be lost. So these are the 7 principles of insurance that we have seen in this video.